Imagine you're at a high-stakes poker table. On one side, you have the German titan, Porsche, engineered to perfection, a symbol of consistent success. On the other, the Italian legend, Ferrari, rare, fiery, and exclusive. For decades, they played the same game. But in 2025, the deck was reshuffled, and we found a hole in Porsche's pocket, the size of a volcanic crater. Welcome to the Great Divergence. Today, we're auditing why one of these icons is entering its Nokia Moment, while the other is rewriting the rules of wealth itself. First, let's look at the old normal. For years, if you bought luxury stocks, you were basically betting that rich people would always stay rich and keep buying shiny things. It felt invincibility, but the 2025 numbers just dropped, and they reveal a brutal split. The luxury label is no longer a safety net. We're seeing a massive divorce between companies that make expensive products and companies that sell pure scarcity. Here's the wow factor that should keep every Porsche shareholder awake at night. In 2025, Porsche's return on bread, what we call ROE, crashed to just 1.3%. Meanwhile, Ferrari is sitting pretty at over 40%. To put that in perspective, for every dollar Porsche puts into the business, they're barely making a penny back right now. They just took a nearly $2 billion hit to their wallet. Is this just a bad year, or is the Hermes of cars turning back into just another car company? Let's talk about cash in the jar. Look at this gap. Ferrari makes about 5 times the profit of Porsche, but here's the kicker. They do it while selling only a tiny fraction of the cars. While Porsche is out there grinding to sell nearly 280,000 vehicles, Ferrari sells fewer cars than a busy Toyota dealership handles in a month, yet they're the ones swimming in gold. It's the difference between being a high-volume factory and a high-end art gallery. Now, Porsche isn't stupid. They're doing something we call kitchen sinking. Imagine you're moving houses and you decide to throw away every broken chair and stained rug all at once so your new place looks clean. Porsche just wrote off $1.9 billion in past mistakes. They're intentionally making today's numbers look like a disaster so that 2026 looks like a miracle recovery. It's a bold move, but it shows just how much junk was hiding under the rug. Let's talk about the elephant in the room, China. For a decade, China was the magic ATM for Porsche. You put a Cayenne in, and stacks of cash came out. Not anymore. Deliveries in China fell by over 26%. Why? Because local Chinese EV brands are building cars that feel like spaceships, and they're doing it for half the price. Ferrari, however, doesn't care. If China slows down, they just ship those cars to a waiting list in Miami or Dubai. They don't have a sales problem, they have a who is worthy problem. Here's the trap. Porsche is tied to their parent company's software, which has been, let's be polite and say, less than perfect. It's like having a supercar body with a 2015 smartphone for a brain. They're having to pause their electric dreams and pivot back to hybrids because the tech just isn't ready. In a world where cars are becoming iPhones on wheels, being stuck in a software trap is the fastest way to become irrelevant. So how does a company that makes almost no cars worth more than a company that makes millions? It's the scarcity paradox. Ferrari has mastered the art of no. When you have a 2-year waiting list for a car that costs more than a house, you aren't in the car business anymore. You're in the social alpha business. Look at Ferrari's new e-building. While everyone else is outsourcing batteries and motors to the lowest bidder, Ferrari is building their own soul in-house. They refuse to let their electric future be a commodity. Every single car they sell is customized. It's the Build-A-Bear for billionaires, and it's why their average selling price is over $500,000. If we look at the scorecard, the results are staggering. Ferrari's business efficiency, the gross margin, is over 50%. That's tech company territory. Porsche is down at 13.9%. In the investment world, Ferrari is treated like a Birkin bag from Hermes, while Porsche is starting to look a lot more like a very nice Mercedes. One is an investment, the other is a depreciating asset. The stock market has already voted. Since their IPO, Porsche has been on a downward slide, losing nearly half its value from the peak. Ferrari? It's up 60%. While Porsche's price follows the mood of the economy, Ferrari is alpha. It moves to its own rhythm, completely disconnected from the struggles of the average person. What's next? Porsche is fighting to get its brain back, investing in software hubs in Shanghai to try and catch up. Ferrari is hedging their bets with e-fuels to keep those screaming V12 engines alive forever, and they're using $4 billion just to buy back their own shares. That's the ultimate flex, having so much spare cash you just buy yourself. Mark your calendars. 2026 is the year of truth. We'll see if Ferrari's first EV, the Luce, can actually feel like a Ferrari, and we'll see if Porsche's big bath actually cleaned the house or if they're still leaking oil. The verdict? 29.5%. That's Ferrari's profit margin, and it's the most powerful number in the industry. It proves that in a world of inflation and uncertainty, absolute scarcity is the only real hedge. Our takeaway? Porsche is in a brutal rescaling phase. They have to prove they aren't the next Nokia. Ferrari, meanwhile, is just checking the waitlist. This audit was brought to you by HDIN Research. If you need this level of deep dive logic for your portfolio or your company, reach out to us at sales@hdinresearch.com. Don't just watch the market. Understand the mechanics behind it. I'm the HDIN analyst, and I'll see you in the next deep dive.